to me, inflation is the hardest thing to protect you. It's protecting yourself against inflation is like no different than trying to get rich. It's difficult, right?
Yeah,
It's like
sure.
it's trying to predict what are the most valuable things. So protecting yourself against inflation is what we're all already trying to do all the time. Just there's more pressure.
All right, episode 37 of the Do Less podcast. We got Brendan, Jeff, and John here. How are you doing today, fellas?
Word, man.
Deuces up.
Why are you still listening? Get a job, get a hobby, do something else.
I can't figure out why any of you are listening. But anyway, so guys, I read and listened to the news for the first time today, and I keep hearing this word inflation. All I heard them talking about is how prices are increasing, and I guess maybe that seems true. I've been spending a lot of money on food and drinks recently, but what is this inflation stuff everyone's talking about?
Inflation is when you move to New York City and everything costs 4 times as much.
That is relatable.
So I think everyone just moved to New York City, and that's why the prices have gone up.
So what's this inflation stuff everyone's talking about? Start here.
John, you tell us.
Well, you gotta make things that are valuable, and people will pay you for them. But if you don't make things that are valuable, and people have a lot of money, all the people with money are gonna bid on the things that are valuable. And it's gonna get expensive because supply and demand.
The worst explanation of inflation you could possibly give. So, what we know from Econ 101, prices tend to be dictated by supply and demand, right? So, if prices are going up, and that's what people are calling this whole inflation business, doesn't that have to mean either supply is being constrained or demand is going up? Is that what this inflation means?
I would agree with that. However, I got a beef with macroeconomics because I think what you said is true, but only true for single goods. Like you can look at one good at a time, but you can't look at many at a time because the concept of demand as a whole, like aggregate demand, that concept in macroeconomics, I think that's a nonsense concept because how do you actually measure demand across everybody, right? Like aggregating across everybody. There's no budget constraint. Like my demand is a reflection of my budget, right? So like I can, depending on how much I produce, I can consume a certain amount. So it's like aggregate demand is a function of aggregate supply because that is our budget constraint. So you can't, I think actually the concept of aggregate demand as independent from supply actually doesn't make any sense because theoretically my demand without a constraint is unlimited. Like, if I would get 1 million Ferraris and 7 mansions and whatever else I could. I wouldn't just like be like, oh, it's, I don't know if I'm feeling as much demand lately if I have no constraint. So really, when the aggregate is concerned, what matters is supply. So when we're talking inflation, we're talking in aggregates. So to me, the relevant variable here is always supply when you're talking about inflation. You can increase the budget constraint, that aggregate demand by, I said it's a nonsense concept, but if you print money, then essentially you've increased budget constraint without increasing supply. And so all you've really done is you haven't changed the supply, but now there's more money around to buy things. So really what matters is the supply of money and the supply of goods. As far as aggregates to certain, like demand, I don't feel like is super relevant.
Jeff, let me say that in another way, and correct me if this isn't, I think this is saying the same thing, but just in another way. You can't stimulate demand. Like people, you hear like mainstream economists talking about, oh, we needed to stimulate demand or else we would have gone into a depression. It's like people don't demand things because you wanted them, or because you can't just snap your fingers and people will demand things. Like Jeff, I think was getting to, it's like a trade-off, right? I demand this because I have enough of this, and then I have enough of all this stuff, and then so I have we as a group, we as a population have a demand for that next marginal good. But stimulating demand is it's a fallacy. And what you've done is you've lowered the relative yeah. What you've done is you've lowered the relative price by giving people more money than they had. They have more purchasing power than they had, and therefore the trade-offs are they fall on a different ratio than they were before. The demand was always there. The demand existed, in that trade-off calculation, but until they got that stimulus, like stimulating their demand, once they got a stimulus check, they've now it lowered the relative price compared to other other things. Is that different, or
Yeah.
is kind of what you're
Well,
saying?
no. So like basically the only trade-off for demand in aggregate is savings, right? So it's, you know, if you have a constraint, you can either save what you earned or you can buy goods with what you earned. So it's like, you know, that if aggregate demand goes up, it's because there's a drop in savings. Like that's like sort of
Right.
like the inventory level. But if we don't like save anything, so it's
Right.
like it's just completely dependent on um, how much money is available. So it's kind of obvious what's going to happen if you print money. Is just there's going to be more money chasing fewer goods.
Mm. So let me get this straight. What you're saying is, when on the micro level, in between me and you trading, supply and demand's likely to dictate our price of whatever our transaction is. If I want to buy some headphones from you, you're going to price them to whatever I can afford, and however many I want might dictate the price, depending on how many you have available. But on the macro level, and take the US for example, so nationally, you're saying we're going to always want about the same amount of goods per person. Everyone's still using the same amount of toilet paper to wiping their ass the same amount, unless people are deciding to save more. But what's more likely changing prices and making prices increase are a couple of factors. One being a change in supply. So if there's less goods available, which could be caused by supply chain shortages that we're having through the coronavirus, like we talked about with our episode with our good friend Paul Rogowski. If there's less toilet paper available, the price is going to go up because the same amount of demand is there, but now there's more people competing for less of the goods. So whoever's going to pay the most for it's going to get it. So one factor could be the supply has gone down, but demand has stayed the same, so price has increased. Alternatively, if the supply and demand hasn't changed and it's been steady, but now everyone has more money through, let's say, something like stimulus checks or some other way that the government or some other form is putting more money in people's pockets, there's just more money out there to be spent. And so people can afford or are willing to pay more money to compete over goods. Is that right?
Yeah, but so the reason I'm saying um, like on the micro level that makes sense is because right for demand for a single good to go up, that's easily understood. Essentially, what people have done is they're buying less of other things in order to get more of this thing. Like demand is a relative concept, right? So demand for an aggregate is like, okay, as opposed to what, right? And the only other thing you can really do with money is save it other than demand it. And, saving levels do fluctuate, but not in a significant way. Like I get like in a recession, people will tend to save more, but there's a reason for that. And so if you try to like stimulate out of it, you're just going to have less productivity with more money out there chasing the fewer goods. So to me, when people are like, "Oh, people came out of the pandemic and they're demanding more," it's it's like demanding more of what? Everything? Probably not. They probably just changed how they spent their money. Maybe people saved more, but it was likely that they spent more on, you know, goods shipped to their house and less on other things. So really, like, demand is more of like a relative concept. It's like it can shift between stuff, but it doesn't, like, as an aggregate, it probably doesn't change up and down very much. What does change significantly is the supply. And so to me, that's really the relevant variable here. Like, there is the money printing, but I think people might be getting ahead of themselves by sort of declaring that this is the, like so the CPI, for example, they said, which is a measure of like a basket of goods over time, how much does it cost? And they create an index out of that. And that number was up like 6%, which is the highest it's been in 30 years. That's why everyone's talking about inflation now. I don't see those baskets of goods that they track as being yet significantly affected by the amount of money printing that has been done. Because usually when the Fed prints money, it goes to like banks, and then banks buy assets and equities and real estate. And so the inflation tends to stay in those pockets and then slowly leak out into other things.
Well,
so I think the inflation.
Hold on. Let's get to there in a second. Before that, I have a question. When you said the sentence like demand relatively stays the same, how would that? And I'm asking you. I don't actually know how you would answer this. How do you consider like an economy that's like demanding like consumption, like pure consumption? So it's like every day there's a lot of spending, but that spending is it has to recur, as opposed to durable goods or is when you say demand is constant, or you said something along those lines?
I mean, it's relative, right? So like, to give you a simple example, if you're on a desert island alone, what's your demand? It's whatever you can produce. It's identical to aggregate demand is aggregate supply. They're one and the same. Mm-hmm. So in that simple example, it shows you they're actually the same thing. So you can increase the complexity of it, right? Add two people. Okay, what's aggregate demand? Okay, it's still whatever you guys produce. You can move it around between you, but ultimately it's what you guys produce. You can put some the savings away, and that wouldn't be considered demand, but in some sense, like, there's not a huge trade-off there. Like, whatever you're building ultimately is going to get consumed. If you're, I don't know, building a house, that's still, like, at some point you might trade the house to the other guy, or you'll just stay in it yourself. But either way, that's not a good metric of what's going on. Like, tracking demand isn't really a good way to track what's going on that island, right? What's a good way to track is, okay, what did you guys make, mm-hmm. right? What's the supply? So all I'm saying is demand at an aggregate level is a function of supply. So you can't really treat it like it's its own variable.
Yeah.
Like because savings are ultimately just supply that didn't get consumed. Mm-hmm. So there's a trade-off between aggregate demand and savings, but savings are just things that got produced that didn't get consumed. So that aggregate demand is just a function of the supply. So supply is really, when you're looking at like a macroeconomic perspective, the most relevant variable, which I believe the supply was significantly affected by COVID. So if you want to go back to listen to our episode with Paul Rogowski, he went into a lot of detail why obviously people drop supply in many things that people normally spend on due to the coronavirus. And when they try to scale back up, it's difficult to do that because some of that supply gets retired, or some of those capital investments get retired, and they're not easily replaced. So what happens is we're producing at a lower level now, but there's still the same amount of money out there. That's what I believe to be causing the inflation.
I think you nailed it when you said there is, like, demand is a function of supply. So, and it goes back to what I was saying about I was saying people try to, like, mainstream economists try to say that, oh, we're just going to stimulate demand, and then once there's a higher demand, then supply will grow to reach that demand. But it's like, that's the cart before the horse. Like, you have to, like, by the point you've stimulated demand, there either are goods or there aren't. Like, the supply is there or not. And once you've stimulated that, people make their future expectations based on that stimulus occurring. But that now they have to say, is that going to continue to occur? Is it going to change? They have to make entrepreneurial decisions, and that's supply. Supply is entrepreneurs making entrepreneurial decisions. That's economics. Like, everything stems from that. You can't just say, oh, we want a great society, so we want to print a bunch of money or make we're going to make people wealthier by giving them dollar bills. And once they have those dollar bills, well, people are going to make so many goods to get those dollar bills. And it's like, no, it's the other way around.
Right. And to like expand, like if you go back to the desert island example, it's like, okay, how are we going to stimulate demand for smartphones? It's like, you can't. You're never going to be able to make one on a desert island. So it's like, there's no way to increase demand for goods that you can have no hope to produce. So it's like, or if you wanted to stimulate demand for fish, that doesn't really mean anything. You just got to go catch more fish,
Right.
So it's like,
Right.
You have to make the stuff in order to demand the stuff.
Mm-hmm.
The trade happens at the, instance of the good existing.
So when I cut you off, you're going into how, to date, the Federal Reserve has expanded their balance sheet. They've eased to the point of accumulating nearly $8 trillion dollars worth of assets in treasury bonds. So that's what they're holding. And the way they got that is they printed money, they printed dollar bills, they exchanged dollar bills for treasury bills and treasury bonds on the open market. So they've accumulated over 8 trillion, or almost 8 trillion. It's probably going to be 8 trillion before January 1st, 2022. And so that excess liquidity that they pumped in through quantitative easing is what I'm describing. It went from a balance sheet of less than 1 trillion as of probably around 2007 to now it's almost 8 trillion, just about less than 15 years later. And so what you were going towards is that money that was pumped in and that went directly to the banks, because those are the banks, the primary dealers specifically. There's like 50 entities, the biggest banks you can think of. They're the ones that can be counterparty to that transaction. So they're receiving those dollars injected in, and you were saying that they have investment bank subsidiaries, right? So when they have higher reserves, it's like, oh, nice. That's like you looking at your checking account going from $500 to $50,000. Well, what are you going to do? Well, you might make some purchases. If you have an investment bank arm of your person that can, realize excess yields beyond, let's say, beat the market by 10% because you're making the market, you will just use that money to continue to make the market and continue to harness the growth of the stock market. So that's what you're saying. So that money goes into stocks and housing and assets. So the asset prices, which are prices, they're not measured in the CPI, the Consumer Price Index. They're not really tracked on any kind of indicator. But assets have been going up directly in line with that. What I was saying with that $8 trillion growth of the Fed balance sheet. The asset prices, stocks and other like housing has gone up. So that's what you're going to say.
Yeah. So like my point was like I'm seeing a lot of people doing like victory laps, being like, the Fed printed all this money and being like, oh,
Yeah.
look, CPI's high now, and
Right.
Biden inflation and all, like, and they're just, I feel like feel as though they've been proven right about everything they're saying. But I think people are getting ahead of themselves, because I think the inflation that the Fed causes, which is real and in my opinion, very destructive to the economy, is destructive in a different way than a lot of people are talking about. I think the CPI inflation is much more likely due to the pandemic than the actual Fed inflation. The Fed inflation, when banks get a bunch of money, they, like you said, they buy equities, they buy real estate, they buy whatever. And then eventually that money turns into income for average people who will buy more stuff. But a lot of those people that are getting that money as income, they're not buying more milk or whatever. It's like, that's not going to cause inflation in the CPI most likely. Eventually it will. But in my opinion, there's like a lag effect, right? You can imagine like pouring water into a bucket with a hole in the bottom, right? The hole in the bottom is, controlling the rate at which all that new water in the bucket is coming out. So in my opinion, the bucket's filling up faster than it's leaking, right? And where we're seeing that inflation is, to give you an example, the S&P has doubled since its lows in March, which was like March 2020, right?
2020, yeah.
Yeah, which was like, kind of like right in the midst of the pandemic when like lockdowns were most severe. The S&P has doubled since then. Okay? And there's just absolutely no way the productivity of our economy has doubled since then. It's just,
right.
That's absurd. There's no chance of that. So to me, that is purely inflationary. That's due to the Fed for sure. And that will find its way into the real economy. But I think people are getting, because, a lot of people talk about this inflation. The Fed always go, oh, it's transitory, whatever, don't worry about it. It may actually like come back down. And if it does, everyone who was doing like victory laps and saying, no, this is all the Fed, no, this is whatever, but it comes back down because, supply gets back to normal and prices come down relatively, but there's still this massive Fed blown asset bubble over here in the corner that they're not measuring. Like MMT people are suddenly gonna like look really smart, and everyone who is saying, Austrian whatever is gonna look like an idiot.
Yeah. Using a monthly CPI print to prove your 10-year macroeconomic thesis. It's like, look, we were right this whole time. It's like, no, well, you were right, but not because, this isn't why. Like, right. I thought the same thing. And I want to, I'll let you, Dale, if you have a question. I want to say something on what Jeff said, but.
Yeah, I think before we dive into something like modern monetary theory and things like that, I'll bring it back to Earth for a second. And so, okay, so prices are going up, but maybe it's transitory because there's supply chain issues from the coronavirus or whatever. And so I can ask, all right, well, why should I care, right? I think one example, one thing that comes to mind for me that's somewhat concerning as a problem that arises out of inflation is that inflation hurts worse for poor people. The people at the bottom get hurt the worst by inflation for the following example. So as you said, when inflation happens, asset prices increase in their value, right? So people holding stocks, people holding real estate, things that are large, expensive assets that people can park money into, increase in value. And so whether you're a wealthy individual or a business or a big bank, all of your assets are now more valuable. And you'll say, okay, so prices went up, so my stock portfolio's value went up, the value of my house went up. Great, that doesn't seem so bad, even though I got to spend more money at the grocery store. But a huge percentage of Americans at the bottom don't hold or own any assets. And so maybe their car value went up, but even a lot of people are leasing their car. And so those people that are living paycheck to paycheck are spending all of their money at the grocery store, on healthcare, childcare, all those things. Those prices are strictly increasing. And if it's increased 6%, like you said, over what is it, the last year increased 6%? Year over year, it's prices.
The monthly data, 6%. By the way, you didn't mention this. The monthly data increased at a rate of 11%.
Yeah.
But
And so
that's just
unless
that was just the month print.
unless those people's wages are increasing at that same rate, that just is less money in the pocket of poor people at the bottom, and that leads to even more wealth inequality in our nation. So that's why I could see that as being a problem. But again, I'll bring it back to, if it's transitory, maybe that means it'll be okay over the next 5 or so years. Things will level back to normal. But I think you were starting to lead towards another point of why that may not be the case.
Well, before I want to kind of, there's an important point that I don't want to like pick on you, Dale, because it's honestly the
Sure.
way that it's our language. It's what people say when they say, "Oh, your stock portfolio is going up. It's increasing in value." It was what you said.
Right.
Like you said, like value, like a bunch of times.
Sure.
And it's like, has it increased in value? And that's one.
Right.
That's the thing that Jeff would.
And so it's mistaking value with price.
Exactly. So
Yeah.
when people say like, oh, like there's a 6% increase in houses, so your house has gone up in 6%. Your value, the house value has gone up in 6%. It's like, has it gone up in 6% in the last year?
Right.
In fact, it's probably gone down. If there's a leaky pipe
Right.
in the basement, or if there's if you haven't maintained it, it could have gone up, but there's probably a relative price that you put into it, that was relevant towards that price increase. Oh, there's an add-on. There's a deck now that cost me $12,000 to put on, and the price went up by $13,000. So you could say the value increase. The value did increase in that scenario. So
Right.
again, it's not that I'm like, but that's the thing. People talk about value as if like, oh, my Dogecoin just went up. It doubled in the last 2 hours. So the value just got crazy. But it's like value is very different from price. Right? Price is what you pay. Value is what you get.
It's a Warren Buffett quote.
Yeah.
Credit your sources, John.
No, Jeff, I made that up.
He's gonna get us pulled from
Yeah.
YouTube for plagiarism.
Which is
I know one Professor Kaiser who would have a lot to say about that as well.
Yeah, exactly. That's actually that's actually the first time I read that, when I was reading one of Kaiser's papers. But then I went on to learn that was a Buffett quote. But yeah, and then Jeff, that's what you said. Something you said, the stock market increased. It went up it doubled in the last year, over like a little bit over a year, and productivity hasn't gone up that much. And while the stock market is an indicator of productivity, because the stock market is the net claims on earning potential of U.S. companies, so the more productive the companies are, the more earning potential there is. So there is a connection there, but for it to double and the production to not increase by double, what is it? What it literally is saying, like the stock prices are the net present value of claims on the future earnings of these legal entities. That's what a stock is. So the collection of all stocks in the stock market, we measure that as the S&P index. For that to double, that means that humans are expecting the net present value of these corporations' earning flow over their lifetime, right? Because you only care about the earnings of a stock in your lifetime, because once it earns more after you're gone, it doesn't matter to you, because you've already passed it on, well, I guess it does matter. It does matter to you then, because if you pass it on to someone you love, you want them to continue earning. So that's all included in the net present value calculation. So
it's all about love.
Yeah, right. So there was twice as much love in the system in the past year. So keep up the good work, everybody.
2 times 0 is still 0.
I'm kind of rambling, but you get what I mean. It hasn't happened.
No, that's a fair criticism of what I said.
Yeah.
You don't just look at the current productivity, but should we expect double the collective future earnings today compared to last year. Like,
Right.
no one thought the
probably
pandemic was
half.
going to last forever. But no one thought it was going to last forever. So there was no reason to expect half as much earning potential 1 year ago as today. That just doesn't that doesn't add up to me.
Right.
So to me, the only explanation for that is the inflation.
Right. I agree with that. I definitely agree with that. I was just being particular with the language.
No, that's fair.
No,
'cause
right.
Yeah, it's a
That's a
useful
fair
lesson.
criticism.
Yeah.
Just to go back to my point, when people exchange price for value in an efficient market, that's what it's approximating. Price is approximating value. But when you have central planning interventionists, it's anything but an efficient market. So you get price signals are very far removed from value signals. And here's an example, right? In a pandemic, in a free market pandemic, savers are the ones that will select where resources are allocated, right? Because savers are the only ones with anything in a pandemic because everyone has to stay home. So who can transact? Well, you have to have something on your person. You can't go out and bargain for anything because you have to. What do you have to give? Because no one's producing anything. So in a pandemic, if you have anything saved, you are the one that gets to go out and say, go out, exchange in some way, in some social distanced way in the pandemic, after you got your vaccine. And just like that, we got demonetized. Actually, I guess you could, technically, I'm advocating for the vaccine in that scenario. So we're still good to go. Cash and checks. So if you have savings at that point, you can go out and you can say, oh, you're somebody who you stored food, I stored water. The people with savings will continue to transact in the way they want to. But in a pandemic with a central planning interventionist, what did they do? They said anybody who is currently employed, you're going to keep getting paid if you stay home. As long as your employer keeps you employed and you don't have to work or anything, you just stay home and you keep getting a paycheck. Well, they've taken the role as the saver in that economy, and they said, we have all the resources, so we're doling out to the people who are staying home playing video games, So that just goes to show you, like, in a really constrained market, what's valuable? Food, water. Those people with those things, they have a lot of benefit to be had because they set the price, essentially. Everyone's trying to get what they have. But in a pandemic where the central planner is acting as the saver, they're helping out. They're making marginally better the people that aren't necessarily contributing anything at all, right? They're just kind of benefiting from the fact that they have an employment. They're one of the lucky ones that gets to keep their paycheck, stuff like that. I thought it was a quick example. That was actually very long. Sorry.
Your example was slightly hyperbolic because I don't think the food supply was really affected that much. But in terms of like other stuff, I would for sure agree. Like things like Ubers went way up in price, right? Because no one wanted to drive Uber and get sick or whatever. So the people willing to do that theoretically should be getting a lot more of the pie because they're taking a lot more risk and there's a lot lower supply. But the problem is when you're just paying people, even if they don't do anything, what you've done is you've socialized the profits that would have otherwise gone to the people who continued to take risks and earn and produce what people still needed.
Yeah,
That's
Jeff.
how I would phrase what you were talking about.
My example is me. I stored food and water. No one wanted it.
So Jeff, what you're saying is like
those central planners.
Like Uber prices did go up, when there was less drivers out there, and the few that were taking risks maybe got a little bit more, but the prices should have gone up even more starkly. But they almost didn't because people could just stay at home and collect a paycheck that was coming from the government, as opposed to being forced to either work and balance prices back out and go drive Uber or do something else. You're saying it more greatly benefited the person who was staying at home because they weren't trading that off. They weren't trading off, work for not getting paid.
It's not that the prices actually probably did still go up, but it's just that the people that are staying home are getting access to the goods while not have contributed anything. They just got the money without actually doing anything. So that's kind of the problem, right? Is now that Uber driver got the money, but the guy who paid him didn't actually make anything. So now when he goes out and tries to spend it, he's running into the inflation, right? Because the supply of other stuff didn't go up, is essentially what I'm trying to say. So I think that's why there seems to always be like a lag effect, right? Because basically, first the supply is constricted, and then people start to essentially the shortages cause the prices to go up, right? When someone runs out of something, then they raise the price, right? Because markets aren't like super efficient, right? Where what generally happens is a producer prices something, and then based on the sales of what they priced, they'll get a demand, right? And if they just sell out all immediately, then they'll either just make a bunch more, or if they can't, they'll just raise the price because they can, right? And so that tends to be the mechanisms that price rise. So there is somewhat of like a delay, and that's why immediately prices didn't go up when the pandemic first hit. It took some time. There's also inventories that people can draw down on. So that's why I think it took a year to start to notice the effects of that supply cuts. Like a perfect example is the PS5. For anyone who wanted one of those, they sold out immediately. Then there was a chip shortage for whatever reason, maybe just not as many people going to work. Maybe it's Bitcoin, I don't know. But the price of one, like a PS5 now on the secondary market's double what it was at retail because just no one can get their hands on one. They're not able to make as much.
Also, my hot take is that what does it say if you can just stop production in an economy and not experience any significant inflation for like a period of a year, like you're saying? Like that means that you don't produce a lot. It means you import a lot. So if you're importing just as much or more, if you're able to, that means that you're fine. You don't have to produce. You can just sit at home and consume if you're able to import. But yeah, so you have to produce before you can consume. And so if you are consuming and you haven't produced that relative amount, then somebody else is subsidizing you.
Right.
What's wrong with that?
And I mean, nothing if you're getting subsidized, but eventually the people we keep sending dollars to are going to be like, why do I keep accepting these?
Yeah.
I can't buy anything with them.
And by that you mean foreign goods that we're importing?
Yeah, for the most part. Like that's where a lot of the dollars go, is foreign businesses accept them for goods that we purchase from them. And then what do they do with them? They buy treasuries with them because those will yield more dollars. And so they keep buying into this dollar system because we don't actually export anything. So the only thing they can buy with those dollars is like our financial assets and stuff like that. So that's how we get the dollars back, is they buy our financial assets. But once people are like, why do I keep buying into this dollar system? Why am I doubling down over and over again? Once that mentality changes, it's going to be very hard to keep inflation down, because if there's a huge reserve of dollars amongst people who are saving them, as soon as they expect those dollars to have lower value, they're going to just start spending them now, and you'll have a huge supply shock of dollars all at once. And that's based on expectations. And that's why you see like the Federal Reserve will never admit that inflation is bad because they understand what that could cause. There's inflation expectations. If they can keep people expecting inflation to just be transitory, don't worry, the dollar's fine, everything's good, we'll get it under control, but don't actually do anything to fix that. They're just hoping to like kind of kick the can down the road and just hope no one notices. But as soon as those expectations change, that creates sort of like a feedback loop, right? Because if I don't expect dollars to have value, I'm going to go out and spend all my dollars now. If I spend all my dollars now, the supply of dollars in circulation goes up, which causes prices to go up, which causes inflation expectations to go up, which causes even more people to spend their dollars. And that's sort of like a positive feedback loop that is very disastrous that I think the Fed is trying to avoid.
So you're saying the Fed knows something they're not telling us?
I think so.
I think so. Yeah.
It's because they're worried about public sentiment and
yeah, because they're not dumb. I don't think they're dumb.
Yeah, no, I don't think they're dumb either.
I want to say an example of that I think it's the one Peter Schiff uses, or a similar one that he uses. But it's like if you had a clothing store that issues gift cards, right? And so you go and you have a gift card to this clothing store, and you buy their clothes, you like their clothes, and then it's like so you're doing that, and then it's like, well, you have an accumulation of gift cards, and what do you do with those gift cards? But you give them back to the gift store and you say, I'm going to lend these to you because I like your clothes so much that I want you to have extra capacity to make more clothes. So I'm going to lend you my accrued gift cards to your store, right? Which is what Jeff was saying, that people, the foreigners that buy treasuries with the dollars that they've accumulated. And it's like, at some point though, the clothing store, if they stop making clothes, like you can still have an accumulation of gift cards and you can transact with them, and especially if it's an efficient means of transacting. Like if everyone in the world transacts with those gift cards, you may not even be too upset that you don't have any clothing options to buy today because you have so many other options. But if you're just getting gift cards and there's nothing to buy at the clothing store, and everybody else is charging more and more, relative to those gift cards, and you're saying, geez, these gift cards just can't buy anything anymore. I'm going to just buy whatever I can as soon as I can, which is what Jeff was saying. People just start spending their gift cards, which are dollars in this scenario.
Right. And I mean, we don't even produce that much stuff to buy. So you're just going to have a ton of demand chasing very few goods. I think what will end up happening is probably they'll buy a lot of real estate if they can, because that's something we can actually offer. But that essentially you've just liquidated all your property at that point, which is not a good recipe for
right.
Long-term production,
And then what happens when the property that you own is not income generating because no one's producing it, because you still got to produce something.
Right.
Even if it's like a house that you own, the person that rents the house from you needs to do something productive, or else they will not be able to get things that are valuable to you without producing something. So yeah, if there's a clothing store that issues credit card or gift cards, and the workers of the clothing store, they're like first in line. They get the most gift cards, and they're like, someday if we ever need to buy clothes, we're set. But then no one's talking about there's no clothes on any of the racks, right? Or there's one shelf, and that's and it's digital clothes. People are like, oh, man, those digital clothes. I'm glad we have access to buy those. Until you need clothes, and they're like, digital clothes, don't cut it. It's not real.
I'll tell you what, if people need JPEGs,
let's go.
$8 million a piece.
I got them for you.
You got some of those, Jeff?
Those.
Jeff, I'm looking for those. You got some?
Yeah, I'm looking for just the thing. So all right. So here's the question. Let's shift the conversation now. You're talking about scenarios in which people are actually afraid of this inflation continuing. Maybe that will be the case. Let's say I'm afraid of that. You're saying in response to that, people are going to spend all their money right now. People are going to buy assets. Does that mean that's what I should do to protect myself? What should I do if I want to make sure that the value of my money doesn't go to nothing?
Just
Excellent
buy.
segue there,
Yeah.
Dale.
Just buy the thing that's going to be valuable in 5 years. Go.
Easy, simple.
Simple.
Yeah.
Billionaires
no,
hate him.
That's a good point. A lot of people think Bitcoin is the answer, but we've talked about that probably enough.
What? No. There's meat on the bone.
So people like to talk about inflation hedges, right? Hedge meaning something that's inversely correlated with whatever thing you're trying to hedge against. So for example, if you wanted to hedge against a stock, you buy something that will move in the exact opposite direction of the price of the stock. So if the price goes down, your hedge goes up by the same amount and you're safe. So that's what a hedge is. I don't think there's actually such thing as an inflation hedge. I don't think that's actually, like, there's things that can somewhat be an inflation hedge, but I don't think there's such thing. And the reason for that is for money, well, all right, so for inflation, what is inflation measuring? It's the purchasing power or the change in the purchasing power of some currency. So for the dollar, if inflation goes up, what we're saying is the purchasing power of that dollar has gone down, which means the price of all other things in aggregate relative to the dollar has gone up. So in order to truly hedge against inflation, you have to own everything else in proportion of exactly how much each thing is going to go up in price relative to the dollar to be perfectly hedged against the dollar.
So I just need to buy a bunch of baskets of goods?
Right. That's what the CPI would tell you. But yeah, so because so in theory, when you hold dollars, right, before the iPhone came out, I was able to buy that with dollars before I even could conceive of a smartphone existing, right? I saved money for something that I didn't even know I could buy in the future. So if I wanted to hedge my ability to buy that smartphone, I couldn't even do it because I wouldn't even have the option to buy it at the time I was trying to hedge. So what you can do is buy other stuff, right, that you think will go up, but I don't think there's such thing as a perfect inflation hedge if you're trying to just buy one asset, right? People will tell you Bitcoin is an inflation hedge. It's like, well, Bitcoin could go down as the dollar goes down.
Yeah,
it could go down at the same time.
Yeah.
Right. So
what you're saying
down,
is, so just see if I can translate. Well, I think what you're saying is, what would be an ideal inflation hedge would be if I could somehow have the average of what the desirable goods are at some point in the future, but some set
desirable assets.
Yeah, sure. But some set of those assets are things technologies that don't exist today. For example, like the iPhone that you said in that example. So I can't buy things that don't exist yet. So I can't have the average of a future basket of goods today. And so another thing a lot of people say is a great inflation hedge is real estate. I think Bitcoin we can understand is super volatile. Why do you think real estate's not a perfect inflation hedge?
Well, it's not that it's like not a partial hedge. Like essentially everything is a partial hedge, right? And real estate is probably one of the more reliable hedges is because like it's just kind of like the basis of society, right? Like,
it's just functional and
property
useful.
is like the first step in society. So it's like it's pretty safe bet, right? But the thing is you also have to ask yourself is what is the relative price of real estate compared to everything else, right? So real estate could be in a bubble while the dollar is in a bubble. If they're in a bubble at the same time, then the value of the dollar drops with real estate. You haven't hedged yourself against inflation, right? The value of real estate relative to everything else can drop, and the value of the dollar relative to everything else can also drop. So,
Right.
like the value of real estate can go up relative to the dollar, but still not preserve your purchasing power as much as some other asset would have. So really like what it means to be like hedged against inflation is just owning the right things, which is just much easier said than done as far as I'm concerned. So
Right.
like that's kind of what I'm getting at is people tend to make it out like it's easy to hedge against inflation, and it's really actually very difficult. And that's why inflation is so nefarious to an economy, is because you're constantly trying to protect yourself against it, but that takes a lot of like resources to figure out how to do that.
Look, if this hurts your head and you don't really know what to do, it's easy. Just invest in a hedge fund. They've solved it for you. That's it.
Is that what that means?
That's what that means. I mean, joking aside, I think that is actually what they. Part of the reason that hedge funds like developed was because people wanted ways to do what Jeff is saying. Like if you're a smart investor and you have all this money in the stock market, even if you're diversified, stocks are often correlated, and in times of like a crash, the correlation can be very strong and can be they can all go negative. So people are like, well, we want to invest in something that's anti-correlated to stocks, and so hedge funds got all these creative derivatives to be like, oh, when this happens, we'll hedge your exposure with this and with that. But as Wall Street does, it's not the moneymaker. The moneymaker is to go in all in on stocks. So hedge funds are very highly exposed to stocks. In fact, they're like almost anti-hedge for stocks now. They're like leveraged exposure to stocks. So it was just a joke. Hedge fund is not your answer. But yeah, it's what Jeff is saying is that value, what we mentioned before, is the hedge. You know, if you have valuable things, then people will buy them in the future. And if you know what people are going to buy in the future, right? If you know what people will find valuable, then you can store that. But yeah,
or create the means to produce them. All right.
Did you say the means to procreate?
Children will always be.
Because yes, that's a great idea. But
yeah, like I just feel like it's one of those things that's just easier said than done, and people so flippantly.
No, yeah,
I don't know. I'm getting very concerned about like the amount of shilling for particular things to protect people from inflation there is out there.
True.
Because to me, inflation is the hardest thing to protect you. It's protecting yourself against inflation is like no different than trying to get rich. It's difficult, right?
Yeah.
It's like
Sure.
It's trying to predict what are the most valuable things. So protecting yourself against inflation is what we're all already trying to do all the time. Just there's more pressure.
Right.
I see. So what about this then? So if I think you kind of got to some answer there in this. So if you want to hedge against inflation, try to own things assets that you think will be valuable in the future or desirable in the future. If you had a magic wand and could, let's say, control the Fed or control, big U.S. banks, etc., what do you think the solution is at the macro level, at the nation state level? You could wave a magic wand to get rid of inflation or to somehow solve these problems. What do you think we need to do as a nation?
Buy Bitcoin.
Yeah, put it on the Fed's balance sheet. No. I mean, it's tough. The solution is not what anyone wants to hear. It's very painful, and you got to start producing. And how do you start producing? Well, you rein in the easy money and the like the factors we were alluding to before, like paying people not to work and paying people to and subsidizing companies that don't make money and subsidizing banks that are too big to fail. Like all this stuff is great for jobs. It's great for GDP, right? The things that politicians pat themselves on the back over, right? All these years for the past, really, it's really the past 15 years, but you could even make the case that it's been the past like 50 years. But, all this stuff that has muted value signals and has exported value signals to countries that we import goods from. Well, how do you reverse that? Well, a lot of people are going to get laid off from malinvestment fueled companies and malinvestment fueled opportunities. And the real investment opportunities are the ones where, Americans aren't used to. It's like mining in a coal mine. It's like really hard work, and we don't do that in the U.S. that much anymore. Like hard work and stuff. It's like if the average American worker is ready to do that, then we have no problems, right? We'll pick up the pickaxes and get out there, and there's no we don't have to worry about inflation, because even if the dollar goes away, we'll have value. We'll be able to transact with some other medium of exchange, but Americans aren't ready to do that. We like not doing that a lot.
Yeah. So John wants labor camps. What do you think, Jeff?
I have a different opinion. No,
No, he doesn't.
well, basically,
He told me offline. He's thinking the same thing.
yeah, so it's like what recessions normally signal when they happen naturally and aren't, circumvented by the Federal Reserve. They're signaling where people need to go, right? So if a company's losing money, eventually it's going to have to close, and eventually because it's not sustainable. It has to profits are sustainable. If you profit, you can keep going. If you don't profit, then you have to eventually stop, because no one's going to just finance that indefinitely. So when a company is losing money for long enough, they're eventually going to retire that model, and everyone who works for it is going to have to do something different, right? So that's what recessions do, is they restructure. We've kind of sold ourselves the idea that we don't have to have recessions. But basically what that means is we're all geniuses and we'll never ever make bad investments. Any company we ever start should never fail, because, like no one should ever lose a job. But that's just absurd, right? There's going to be bad investments and they're going to need restructured. And sometimes they all happen at the same time and they all need to close down at the same time. That's what a recession is. So that period is painful because the supply constricts, because a bunch of people have to now move into different things, and that takes time, training, whatever. And so it's not fun, but it's the only way forward. We've been able to circumvent it because the world has trusted the dollar so much for so long that we've been able to keep increasing our trade deficit and importing more and more and more stuff, because people still have trusted the dollar for this long. And so our shelves, like if you go into Walmart, other than the food, pretty much nothing in there was produced in America, except maybe some of the raw materials. So all of that production, if it's not happening here, we either need to figure out something other than just dollars or debt to send back, or we're going to have to make it ourselves. So one or the other is going to have to give eventually, unless the world just wants to finance us forever because we're cool or something. Like, eventually something's got to give. I just don't see why the rest of the world, because people are so used to this, but prior to the 1970s, just about everything was made in America. Like, if you got stuff made somewhere else, it was considered like cheap and like, people laughed at, oh, that was made in China. Haha, that's probably crap. And now it's like, that was made in America. Like, how? It's
Yeah.
like not even feasible.
Right.
Good luck buying a TV made in America.
Right. It's
Yep.
just like impossible.
Yeah.
I do want to add one thing because, you know, on its face, what I'm saying is like really bad news. Like it sounds really bad, but the good thing is it's not bad news. Like it's not hard to reallocate resources. It takes a little bit, you know. It'll be hard for a little bit, you know, for sure. But that's the thing about like free markets. They have a way of assigning value to things that are valuable. The people that are able to produce the valuable things make the decisions because they can go on to make more valuable things, and it grows from there, right? So as long as you can leave it in the hands of the free market, then it'll solve itself relatively quickly. The problem comes, and where the real pain comes, is when people double down on their interventionist approach and say, well, all of the decisions that led us to this point surely were not the problem. The problem was some scapegoat, some group of people, they'll point to someone and say, these are the people that are the reason that that you're experiencing so much pain. And doesn't it suck? You used to not work and you used to get all this nice stuff, and now you're not working and you don't have any nice things because they took it all from you. And so once they start doing stuff like that, then you get like genocides and Holocausts.
Yeah.
That
All that
sucks.
fun stuff.
So what you're saying is, maybe one way to put it is that free markets allow nature to take its course and allow businesses that don't create value to fail, so that money can be allocated to the businesses that do create value, and in doing so allow natural selection of value creation, and that's how our economy can evolve.
Yeah, I think that's a fair way to put
that's
it.
fair.
It's also just, it's about like the word, a lot of people throw around the word sustainability. Well, profits are sustainable. Deficits are not, right? Because essentially deficits draw down on some resource, whether it's savings, whatever it is, it's going to draw. So it's like the only way to have a sustainable economy is with profitable businesses. So right now, for example, like on the S&P, somewhat like half of the stocks on there are not profitable and have never been, or
That's
at least
wild.
not in the last year. So you have a situation where we keep financing and doubling down on bad ideas because we're convinced that we're not wrong, like that these were good investments. This was, nothing was wrong. Like nothing needs to change. No one needs to get retrained. No one needs to get laid off. So by doubling down, we're just making the problem worse because we're going deeper and deeper into deficits or, debt, where we're drawing down from the resources we need and not putting them in the right places.
Yeah, it's a good way to put it. I've said before on this podcast, people think that like the worst case scenario is like you'd lose your job, but really the worst case scenario is that you embed yourself in an industry or at a company that's not creating value because you were sold a like an incomplete picture of like what your contribution is, right? Everybody wants to contribute. Everyone wants to, be part of the value creating activity. But if you're being subsidized from a real productive sector and your sector is not, then you just think that you're being productive and you get your paycheck, but you've been lied to. And so once reality sets in, and whether it's inflation or if the government chooses to rein in the inflation, which would also cause the same result as we're describing with inflation, where like the excess lending and the excess credit kind of goes away, and you have to be left with like value producing entities. I don't know where I was going with that.
Back to the coal mines, people.
No, I mean, I don't think people need to be mining coal really. I think we actually do produce a decent amount of it already. But
No, yeah,
in terms of like,
that was probably a bad
right,
example.
it was just a flippant example.
Probably
But
more like something
Yeah.
like farming or like something like
I don't even think farming. I think that's
factories.
another thing we're pretty set on. I would say it's more manufacturing is where we're
Falling
really
behind.
weak, which we used to be better on.
Yeah. All right. Well,
And
go ahead.
it's not all bad. Like right, like for example, manufacturing um, sectors tend to produce a lot of like middle class jobs, right? Like sure you're gonna have like
Yeah.
people on the factory floor doing things, but you need a lot of middle management and like upper management type stuff that are good value creating jobs that the American middle class is kind of built on. And so we've been basically just spending that reputation ever since. I liken it to like, let's say you had a really high paying job, and so you were like a awesome lawyer and making $500,000 a year, whatever. And so your credit card limit is like, um, I don't know, $50,000 a month or something crazy. Um, if you lost your job, your credit card company is not going to necessarily know about that, and you could just keep living like your old lifestyle on that credit limit until eventually the credit card company comes to collect, and then you're screwed. And like, yeah, that sucks. You're no longer going to not be employed living an awesome lifestyle. But eventually you got to do something productive and to get back to that lifestyle you're at. But like, it's not like you can't do it. You were doing it before. You'll
Right.
find a way to do it.
Yeah,
It's just you have to do it.
right. Yeah, where I was going, I remembered what my final point, or like the point I was leading towards was, um, it's like when the government steps in and has that stance of like we're going to protect people's jobs in a pandemic or in a recession. We're going to make sure that no, the biggest companies have the most jobs, so we have to make sure they don't fail because that would be the most layoffs. Right? They're inherently making this promise that it's like, we're not going to let you lose your job, right? And that's just you've like they can't do that. They don't produce anything. They don't produce. They don't make they don't create jobs. They can only reallocate things. So it's a promise that they can't keep. And so when I see people on Twitter saying things like anybody who thinks that reining in inflation through the use of like tightened monetary policy from the Federal Reserve, you need to be the one to tell me whose job is the first to go. Like, tell me what sector, what job, what individual firms need to lose employees, and tell those people that they're out of a job. And it's just like, so as Jeff was saying, oh, I'm sure there was the on the other hand, I'm sure when we were making these policies to make easy money, you were going to the middle class workers, like Jeff was just pointing out, and saying, sorry, no more middle class workers in this sector, and sorry, we don't want any middle class work, No, like the whole time the promise has been you're not going to lose your job, but what has the promise been? Oh, we're just going to fund and subsidize these big companies, right? It's like
Yeah, and even I think even worse than that, it's not okay. You go tell people who gets to lose their job. It's that the market's going to tell people who loses
Right.
their job.
Right.
Like you are determining who
Yeah.
loses their job by where you choose to spend your money.
Right. Like
Yeah.
they're trying to put the burden of proof on you, but the reality is like I don't have to figure that out because that's not my job. What
Because
you have
where
to
you
figure out.
choose to spend your money is going to determine how that.
Yeah.
Right.
So
So yeah, and like to that point, um, John, is like we have like empirical evidence about how this works out. When the banks were bailed out in '08, that should have failed. What did all the companies do with those bailout money? They paid all their executives huge bonuses, and didn't make any good decisions with that money,
Yeah.
because that's the reason they're in that position, because they make bad decisions.
Right.
If you keep giving money to those people, that's insane.
Right.
It's foolish. But I feel like that's by design. But
all you need to do is be rich and powerful. That's a good inflation hedge.
Right.
True.
I can't.
Any final thoughts, guys? I think we're coming up on 70 minutes.
I think that's all.
Yeah, I think that's a good way to end it. Get rich and powerful, and you don't have to worry too much about inflation.
Yeah.
Well, I guess I'll say that. Well, we didn't mention it this whole episode. I think gold is a relatively stable store of value. That I would say it's not gonna make you rich, but if you have some wealth, you should definitely consider allocating a portion to a metal that is the most important, or like the most useful metal on the periodic table. But
do I need to buy physical gold, or can I just invest in a gold fund on Robinhood?
I mean,
physical is probably safer.
Yeah, whatever your risk tolerance.
Unless you think you're gonna get robbed, but
yeah.
Like the only thing with ETFs is like the USO problem, whereas if they're competent and they're getting the gold or whatever they need to do to back their ETF, then it might be all right. But
you're probably not doing the research.
Taking that counterparty risk.
Yeah.
Yeah.
But I'll add one final thought to what John was saying is.
Well, before you said what he mentioned in USO, that's the oil ETF.
Oil, yeah.
That was I mean, the only way they don't store oil, they have oil futures, and the oil future derivative product they were using was, over leveraged on a single oil product that wasn't able to be delivered. It's largely the reason people think why oil price went negative last year. But I mean, with the gold ETF with GLD, they at least claim to hold gold in a warehouse, so it's a little different.
Right, but all I'm saying is there's always that risk is they don't have the gold they say they have.
Yeah, right.
That's fraud and that's illegal, but people do illegal things all the time, so like you can't just necessarily go off of that. But what I will say is, while I do think gold is a really cool metal, I'm not gonna say for sure it's gonna preserve your value. Like theoretically, the apocalyptic scenario, the best thing to have is like canned food and distilled water, and like there's not a lot you can really do with gold in that situation. So I'm just saying, you can imagine scenarios where certain assets don't pan out. So I don't think anything's like a guarantee.
Right.
And so I'll never put a guarantee on anything. But what I am pretty confident of is the dollar is going to continuously lose value. So just holding cash is probably not a smart thing to do.
So cash is trash. Well, I now live in a New York City apartment, so I don't have room to fill it with food and distilled water. So I'm going to line it in gold, and I should be safe.
Yeah, dude, you can put it in the sock drawer.
That's right.
Dude, like a gold coin like this is like $2,000.
Yeah.
So I don't think you'll be lining your house anytime soon.
You don't know my financial situation.
If you have that much cash, I'm concerned.
That's true. That's a good point.
I was listening to something it was a while ago, but a guy was saying that there's like a loophole where you could like build a house with gold bricks, and like the house construction is like a write-off. So you can like just like buy gold on like an alleviated
and then it'll
tax
just
bill.
sink into the earth. Way too fucking heavy.
Yeah, it'd just be like $1 billion.
Shit, my gold house is sinking.
Yeah.
Alright. I like
That's
it.
all from me.
All right.
Thanks for tuning in, folks. If you're still listening, you're crazy. Later.